So today we're going to be talking about the landscape in and around aggregators. We've got lots of experience here on the panels. We had a pre-chat outside. There's a lot of stuff that has gone on recently. We've seen all the shifts and movements in the market. These ladies and gentlemen are going to be transparent and answer a lot of the questions that we'll be discussing to obviously help educate everyone in the room. I'm going to start by going around the room with everyone introducing themselves, starting with Olivia.
Sure. Hi, everyone. I'm Olivia Jones. I'm a director in the acquisitions team at Branded.
Hi, I'm Johan Halliby, founder and CEO of Go North. Based in Sweden, started my first brand as a seller 2020. Acquired the first brand December. Now we have 13 in our group. Over to John.
John, one of the founders of Thrasio, recently retired. When I left, we had 200 brands doing about 1.5 billion in revenue a year or so.
Hi, I'm Aida. I'm one of the co-founders at Nextoria. We provide M&A services focused on e-commerce businesses, so helping e-commerce sellers who are looking to sell their business.
Hi, I'm Lorenzo. I am an investment associate at CeleRx. It's a European aggregator. We were founded in 2020. We have, at the moment, roughly 40 brands.
Hey everyone, I'm David. I lead the investments team at Olsam Group. We're a UK-based acquirer of e-commerce and marketplace-enabled consumer brands.
Okay, so let's quickly start off with the first question on the cover. We've noticed that there's been a lot of aggregators coming into the space, maybe 100 or so, could be more, and there's been a lot of buying activity been going on over the last 2 months. So we're now starting to see the market calm down slightly. A lot of the businesses that are sitting at the top of search have been bought, whether they've been from an aggregator or purchased elsewhere. So it's interesting to see how the market is shifting. Now, John, how many brands does Thrasio now?
It's north of 200.
Right, so you've got 200, you just said you had 40. Olivia? 50. So there's quite a lot of brands there, but then if you look at the magnitude and you add that to 100 other aggregators, some have not been as smart as these guys with their money. They've been good at raising money, but gone and bought brands that may not convert as well. Now, starting with you, John, have you seen the market change over the last 18 months?
Sure, I'll start all the way back in 2018 when really we got into business. We spent the first 2 years buying at very low multiples. We were able to restructure our debt. We had virtually no competition, so any mistakes we made were easily erased by just the metrics of the market. And then at that point, right before COVID, we probably had 60, 70 brands, something along those lines. And all of a sudden, the gold rush started, right? So the market flooded with competitors, but we hit this incredible COVID bump where sales on Amazon went up. And then more people started investing money and entering the space. And what had happened during the gold rush is there's going to be some sloppiness, right? There's going to be some fast and easy money. And you had look at our business where we were buying things at very low multiples with zero competition for 2 years. Fast forward to 2020, post-COVID, you had people with really high debt rate, with very little experience in a very competitive buying market, where the multiples were 3 times as high as they were when we purchased it. What that does is it means it leaves zero room for error. And then we have changing economic conditions, the end of the COVID bump, and what that's going to create naturally is an extensive amount of volatility in the market, both from an aggregator standpoint and really from an operational excellence. And look, everyone who's investing money in this space, for the most part, these guys all know each other, right? They always have information about what other people are doing. And as soon as they see sort of cracks in the foundation, and this is not the newest and sexiest idea anymore, conditions are going to change. And when the economy takes a turn, people who are giving you money are going to do a lot more diligence on who they're giving money to. So I think that's what we're seeing here is just like naturally. You have a gold rush, it's 1849 in San Francisco. You find a little bit of gold, thousands of people rush in, there's not enough gold to go around, that creates a bubble, it deflates, and then it starts to sort of climb up. I think we're at a place where we're reaching stabilization, and we're going to see an upward trajectory again that's going to be not as massive or as parabolic as it was last time, but rather a smoother sort of like wave up.
Excellent. David, would you like to add any points here?
Yeah, I mean, just what John said, I think there's kind of different cohorts. So there's kind of the original Thrasio, Perch, who started early, who, operated in a less competitive environment. And there's definitely the next cohort, or kind of what Razor, Seller X, some of the US ones which entered the market, who could take advantage. They acquired some brands in 2019, could take advantage of some of the acceleration of the brand, but also acquired quite a few brands in 2020, which have maybe not performed as well. And then I think there's now a third cohort, which started later, which are a bit subscale, kind of more operational prowess, are learning from the mistakes not mistakes, but I mean, it's easy to make mistakes when you're kind of the pioneer in the space. But I think there's now a third group, the subscale, who are going about this in a slightly different way, going slower, very methodical, maybe acquire not 100 brands, but they'll only acquire 30, 40 brands, and maybe the trajectory will be slightly different. And I think all of the aggregators will learn from each other and see what others are doing, who are they hiring, where they're building out, are they focusing on NPD, is somebody relocating supply chain to other countries, and I think the best practices will establish itself across all aggregators, and then we'll have a model which will look uniform, but still have differentiation on different categories, different geographies, slightly different mix, more wholesale, could be moving into Shopify. So I think it will stay very dynamic, the space, and there'll be a lot of movement, and for sure I think really interesting, and still a lot to go after. I mean, it's only been 2 years, and I think an industry which is very large, has a lot of runway.
Yeah. Lorenzo, do you have any points you'd like to add here?
I agree with what's been said so far. I think it's important to understand that. I mean, in our view, the market's probably been overheated. In last year up until the earlier part of this year. But I mean, we're strongly believers that the fundamentals of e-commerce are just here to stay. The long-term trajectory in terms of penetration, as you guys know, is accelerated last year. Over the secular trend that was meant to be, and now it's just going back to probably normality. I think that the market was overheated. As we discussed, there were many indicators came to the market, and obviously this just created competition. We know what competition creates. Competition for us, it's still has been for private equity in the broader space for the past few years. Driving even private valuations up on all the other sectors. I think this is happening in our market as well. I think as of now, what happened this year is obviously there's been a few macro headwinds. I mean, I think even normalization in that sense, because if you guys think about increasing interest rates, it's just going back to what it was. I'm actually very young, so I hardly remember interest rates. I've studied them, but they're coming back, right? So, and it's just how the economy works. So this creates the fact that obviously capital is not free. It's not free for private equity. It's not free for venture capital any longer, which is the main backers of all our companies. And I think this came into all the board meetings of our companies. The idea to obviously stay more conscious with our capital. I think that's the message for this year. And this is going to reflect in the market in terms of what we're going to do in terms of acquisitions. So on one side, staying again very conscious on the capital, really not splashing cash any longer. And I think this applies to all of the markets. So everybody's going to be more conscious. I think multiples are going to normalize, because the other thing I really wanted to convey is that I think the multiples just were not normal. For such a business, it's still a risky business. It's not. We're not buying government bonds. Speaking about interest rates, you need to apply the riskiness factors in such investment. So I think multiples are normalizing, will normalize, will continue to do so. And as usual in this kind of environments, obviously there is going to be a differentiation for the lower quality assets and then the best quality assets, which will still remain competitive.
Yeah. I mean, John, we spoke about on the podcast, I know you guys passed on a few businesses where they've been offered, silly offers, like the multiples going past 6 and 7. I know recently, in the last 6 months, it peaked around 6 and 7, didn't it? What are some of the most extreme ones that you've heard of, where someone's come in and says we've been offered 10x, etc., etc.?
Look, when the market was at its sort of peak, there were some really crazy multiples going on, really because people had to deploy capital, right? And if they looked at a brand that I think they thought had potential maybe on the IP side or growth, they would bet on the growth and really overpay. But it was getting to a point where we were just looking at assets, and clearly reality did not match what they were. Right, and that's the thing. It's really hard when you're on the other side and you're a seller and you're hearing these stories of people getting crazy multiples, and you set this anchor in your head. Well, that should be the value of my business. But does your business have all the pieces that the brands that went for a really high multiple went for? And the answer is probably no. And so now the seller community will have to re-anchor themselves to a different reality as we move in the market going forward. And it'll be interesting to see how it settles out. But in my mind, look, the cost of capital is going up. The people giving money to aggregators, it's getting tighter and harder to access. It's going to be a changing market. So as a seller, you have to strategize on when's a good time for maybe me to enter the market and take an exit. And it probably is not today, but it might be in 6 months, and it might be a year from now.
Yeah. What about yourself? What's some of the craziest multiples that you've seen?
I mean, I think we've seen crazy multiples like everyone else. And I think one of the things that John mentioned, which is important, is that we see a lot of sellers who are still anchored on these multiples that they heard. And we kind of have to be the bad guy and be like, it's not going to happen, right? Like you've heard, like maybe one of your friends got lucky, sold for 7x, maybe the business was a bit different, but today that's not what's going to happen. And actually what we're seeing now is, I agree, the multiples were too high, the average multiple was too high. The good businesses still go for high multiples, but there's a lot of due diligence that happens behind it. These are not like the average business that's going to go now at a 7x.
Yeah, we'll get into that in the moment as well. Johan, crazy multiples, what have you seen?
Yeah, not seen so high ones yet, but we're just a few months in. But so since I'm coming from the seller side, and all you guys have already mentioned all what's happening on the market economically, and what we are seeing is that I think that sellers getting more knowledgeable about the space. And actually, as John said, like they started 2018, they were the first aggregator. It's just now that we see what has happened with a lot of sellers that have sold their businesses to an aggregator. So I think that what we will see is a lot of more sellers getting more knowledgeable about how to sell their business and web services like yours, etc. I think someone will be more picky of, okay, who's going to run my account? If I have an earnout, why should I leave my account in someone else's hands that maybe can manage it poorly compared to myself? Well, why should I give that opportunity? And that's, I think, could be one thing that sellers will be more picky. Also, maybe higher upfront payments due to what has happened. And if I'm listening into different sellers' networks, and there is a lot of stories what has been going on with non-paid out earnouts due to a lot of things. Could be conscious behavior, running marketing ads, lowering net profit to not pay out the earnout, and then you have actually just boost the sales but will lower net profit, and then you can scale from there 12 months post-acquisition, which is not good for the seller, of course. So I think that we will see. And lastly, I also think that with that said, it will be harder for aggregators just to enter in the space. I think, as you mentioned, maybe you need some niche, or we are best in running this kind of brands within this category, or as we try to be. I mean, I'm an operator myself. That's our strength. So that's something. So I also think for the sellers that they need to find the right buyer to get higher multiples, as we were talking about. Because if you can synchronize that fit, then the buyer will always be able to pay higher multiples because it's a higher synergy for the acquisition.
Yeah, so effectively it's about having the right dance partner, yeah? So there's synergy there. The other thing I want to add as well is going back to that space where a lot of the businesses, the key businesses, have been bought. Right, and this is an observation. This is not statistics. Is that you see the entrepreneurs who sold are coming back, but taking a lot longer to come back. There's less pressure now, right? So they buy some property, they've got the money in the bank, they're back against the wall. So when they're doing their samples, they're scared that the next time around that maybe they'll fail. So they'll spend a year or so, year and a half in the sample process. So you're left with a little gap in the market of that talent pool, whilst the new breed comes through. So over the next 18 months, we'll see that next wave of entrepreneurs that are fitting to be at that level because they've developed those skill sets. So I think we've got a little bit of a gap in the market. Would you agree? Would you say that, John?
That's fair.
Yeah, a little bit of gap in the market, and it's like most of you guys here are the guys of tomorrow. Yeah, so you might be doing, I don't know, 1.5, 1.6, 1.7 million, and you're growing, and we'll see a next wave of sellers coming through. Then I think going back to John's next boom, that next cycle, we kind of come from a peak, we're about here, and then we'll come up again over a period of time. But I think it's that next breed of entrepreneurs. I was expecting a lot more entrepreneurs to come back faster. They will scale faster, but I see there's a little bit of fear in some of them, is that can I create that again? And I've got the money in the bank. Do I want to go again? So they might only dip their toe in with getting those samples. Discovery. Obviously, a couple of years ago, we see discovery was a lot faster and you could sell your business a lot faster. There's been adjustments made, right? Because you guys have got to buy the right business as well. Starting with you, Olivia, what changes have you seen in discovery? Because that process takes a bit longer now than it did before.
Yeah, so I think two things probably. One, the aggregators in general have got smarter, and we've learned from the businesses that we've bought different questions to ask that maybe we weren't asking the first time round. So you kind of learn the hard way, things that you missed, and next time you ask them, you have a longer list of questions. You're a bit smarter around the questions you're asking and the depth that you go on certain topics. And so it does take a bit longer. And also, at least for branded, and I think it's the case for others as well, to start with, we were just buying very simple, often one market, pure Amazon businesses. And the reality is those businesses are just faster to diligence. Now we're looking at larger companies, and they often sell omni-channel, or they're in multiple different markets. And for that reason also, it's just going to take you longer to diligence a business that has one supplier versus 10 suppliers. So I think those are, for me, the two reasons why that whole discovery process is getting longer. But hopefully, I think sellers are also getting a bit better prepared for that process because they've seen friends and others go through it, and there are advisors in the space that have now been through it multiple times. So hopefully the sellers know a bit what to prepare in advance, and hopefully at the end of that process you come out with a more informed buyer who knows your brand better and is better able to run it on the other side, even if it's a bit of a painful process to go through. But then it always is, whether it's 30 days or 90 days.
Excellent. And obviously discovery works for both sides. It's important to get that right. Yeah, like you said, sellers are getting much better now at putting their figures together for the business as well.
And also maybe diligencing their buyer as well. As
yes.
Someone said, I can't remember who, but they're a bit smarter on getting to the person who will actually run that brand and seeing do these people know what they're talking about.
Excellent. We'll come up to operations a bit later as well. Anyone want to cover on this point as well? Any changes at CellaX, for instance, in terms of the length of time of discovery?
I think something to add is I think she earlier touched on probably a little bit also on the length of the due diligence process. I think even on my personal experience, I can say that I've seen the times getting a little bit longer than it used to be at the start, probably. I think this is a function of what Olivia said, you just learn and you want to ask more questions. And also you structure your process much more, right? In terms of investment committees, in terms of, decision-making processes, you get more structure at the start. Even myself, at the start, I would say maybe I could take so many more decisions that I can as of now in a way, because obviously, now you're more structured in terms, as I said, in investment committees and so on and so forth. At the same time, you learn more, but also, as Olivia said again, you learn from mistakes, so you want to change your processes. Like our due diligence process is completely different to when I joined. Like it's completely different. Pretty much anything that we're doing is very, very, very different. And it's different from any acquisitions that you do. For example, I was speaking with David right before the panel, like we did a huge acquisition, like a merger at the end of last year, and obviously these guys are really good on many functions, and they're helping us on many fronts of due diligence. And just to name one, quality control. Like right now, the guys have a really good function in Asia, and during the diligence, we're doing this. We're just sending samples there and checking how the product really is. And it's something obviously we weren't able to do before. Like obviously you ordered a product in Europe, but we can really do it much better. Like the guys at quality control are amazing. And just to name an example, like we went not to pursue an acquisition recently because we actually really found out that the product was, despite the ratings on Amazon, it was just not really good. So obviously in the medium to long term, it's not sustainable, despite the ratings that you could have.
Yeah, David, your fault.
Yeah, really to echo what Olivia said, I mean, obviously everybody starts with very simple acquisitions, they grow, they get more complicated. I think what we've seen with we bought a group of brands, a smaller aggregator called Market Fleet. They came with a group of people. They joined us on the US side. The integration planning gets more complex and involved, and bringing on people is not trivial. And you want to do it right in the right way to make sure the integration both on the operation side and the cultural side is as seamless as possible. The other thing I would say, in 2020, when we started, I think everybody assumed that the supply chain logistics part would just work. And I think for most aggregators, that probably added 1 to 3 weeks just on the supply chain logistics due diligence, because for every ASIN, you have to make sure that it's already in the warehouse, when it's going to land, are you able to sell it? Because there's been, before 2020, not as a significant issue because there was excess capacity, things would arrive on time, and I think overall that process has gotten a lot more involved to make sure you hit also the earnouts. If you don't have the inventory, you're not going to hit the earnouts as well. So it's very, very important, conversation with the seller.
Yeah, indeed. Any more comments from yourself?
Sure. So that's definitely something we've observed, right? Buyers spend a lot more time, even before the due diligence, before getting to the initial offer. And part of our role as an advisor is to help sellers be ready for that. But for some, it's actually not a bad thing, right? For us, it is a big red flag when we have a buyer who's not asking enough questions. We've actually advised sellers to not take offers from buyers who we're not looking to close enough, because we don't want to get to an LOI and have bad surprises after that. So I think it's just part of we were all figuring things out as we went. I think now it's getting a bit more professional, and that's how it's going to continue to be. But at the end, it's better for everyone.
Also, we've seen recently some aggregators are on pause, which is actually a positive thing. Obviously, people speak about it in the community, and it's obviously in some of the news articles and stuff. But being on pause is a positive for earnouts and things like that as well. I'm not saying any of you guys are on pause on the panel, but for those on the panel here, what would pause mean for most aggregators? What are the benefits of that, Olivia?
Well, I think what people also need to understand is how the aggregators themselves are funded, right? So investors give us money to prove out this thesis that we can build platforms that take brands and make them better, that take advantage of economies of scale and use teams of experts to grow these brands better than a smaller team or even an individual could do. And so there's going to be always a natural cycle between you get given that money, you deploy that money, and then you have to prove you actually grew the brands that you bought before you can go back and just randomly say, give me more money. So there'll always be natural cycles for each of the aggregators of that raise, deploy, prove it out, raise, deploy, prove it out. And because this was just such a weird market where so many people entered at the same time and all raised at the same time, there's also a bit of an element that everyone's doing that digesting and proving out process at the same time. So it doesn't necessarily mean that aggregators won't raise and buy again. A lot of them will. So as sellers, you just need to be a bit aware of that cycle. And when everyone's in deploy mode, the multiples will naturally come back up. Maybe not to the crazy heights of last year, but who knows, there'll be cycles, and it's a weird market where a lot of us are on the same cycle. So just kind of watch out for that.
Anyone want to add to Olivia's comments?
Yeah, I'm happy to add a bit to that, because I think one thing, so as Olivia was saying, I think we were expecting to see this slowdown. If you've acquired 50 brands in less than 2 years, it takes a lot of work also to integrate them. And you're not in such a hurry to buy more and more brands, so that's quite a lot. But also, one thing to note is we tend to refer to aggregators and think of them sometimes a bit of a mistake as homogeneous group. I think David, you touched on that a bit earlier. Not everyone is at the same stage. It happens to be that the biggest ones are the ones that are kind of slowing things down naturally, but you have some other smaller ones that are still at a different stage. And even, I don't think there are that many who are really on pause. They're just more strategic about what they're requiring. And I think that's really the important thing that we're seeing. There's still a lot of interest, but they're just going to be more strategic about the type of acquisitions they make.
Yeah, and if there's not good businesses in the market to buy, why would you just throw money at it for the sake of meeting quota each month? John?
I mean, yeah, this is one topic I'm very familiar with. Let's put it that way. The building a business, a small business, is immensely complex. As you go, as we did from 4 of us to 50 to 100 to 1,000 to well over 1,500 people. As you scale a business like that, things that seem simple become immensely complex. Spans of control, communication, leadership, multi-channel things you're in. Everything is harder than you think, and then things slow down. And then, by the way, when you hit a certain scale, you need real systems built that are able to take on the operational load. So one of the reasons for Thrasio's choice to slow things down was really to let the systems catch up. We spent a lot of time throwing people at problems, and we've invested a massive amount in tech in the back end, and that's coming to fruition now for them. And it will allow for the next wave of things to be digested and taken in. We were at a pace at one point where we were buying up to 4 businesses a week, and that went on for months, right? You talk about, flying a plane as you're building it. We were certainly there. And we had systems in place, but we've had to rebuild the structure of the organization over 4 times in 4 years. So every year it's a total reflip of how we're run and how we operate, what our methodology is and everything like that. So for us, it was a realization that you can't have a parabolic curve forever. It's certainly not sustainable, right? You need a stasis point, and then you need proof points that when you're at the stasis point, things are going well. And for every seller here, I'm sure you're noticing selling on Amazon is getting just a little bit harder. Just like every marketplace, advertising costs go up over time, margins get compressed. You have shipping and other conditions like that. It makes those proof points harder to execute. It is very doable, and I think Thrasio is doing an excellent job of meeting those proof points and getting ready for the next phase of growth shortly, in my opinion. But to understand, again, the complexities and difficulty of scaling a business and taking on 200 or 100 or 50 separate businesses and integrating them, it's an immense undertaking. It might sound simple, but it's incredibly complex. So I think everyone on this panel, when they hit a certain threshold, will have to take moments of pause to figure out how to continue growth effectively.
Yeah, indeed. Anyone else got any comments here? No? Okay, so moving on. Let's have a chat about aggregators aggregating each other. Yeah, so we've seen what's been going on in the market. Has any of you guys purchased anyone else that's official and open to speak about? No?
We acquired, 2 smaller aggregators. I think the first one was, Flywheel, active in the pet space, and then more recently Market Fleet, which was a US brand, mostly active in the outdoors, fishing, summer sports space. I think with, these aggregators, they just didn't have the people and processes in place to go for scale. They were able to acquire just a handful, and were they able to raise more money? Are we able to invest in technology? Are we able to hire more people, get the right capabilities, or do we get to the point that we want to sell? I think similar to most Amazon FBA sellers that may have been running since 2015, they've been in the market for 5 years and decided to sell in 2020, just hitting a ceiling or an inflection point where, what does the next phase look like, and then bringing them on. I mean, for us, it was interesting because some of these were aggregators before it was called aggregators. These were groups of brands that have been operating for 5-6 years. And we actually found it really interesting from a people perspective because there's actually not that much talent who has been doing this for 5-6 years. And that was for us a really significant USP, so bringing over the teams, help us level up, skill up, and with all the other acquisitions that we're building, and they were fantastic brands to bring on board to the Olsam platform as well. But I think this will be a continuing theme, and I think all the acquisitions it's ideally you want to. I don't know what a major acquisition would look like in this space. I think these kind of like smaller group of brands, like 5, 10, 15 kind of smaller aggregators are great to absorb, great to integrate. If somebody who has 100 brands decides to sell themselves, I'm not sure how that's going to look like and work out, but I'll let the others comment.
So the fact that, we talk about aggregators aggregating, is there two parts? There's like an acqui-hire where they bring in the talent from the aggregators more so than the brands, because they won't be aggregated if the brands will perform it. True?
Can you repeat the question?
So the 2 points to that was with some of the aggregators that are being aggregated, not i.e. being bought from someone else. Is it more about the talent or the brands, because they wouldn't necessarily be aggregated and bought if the brands were performing well?
Sure. I mean, look, it goes back to my previous points. Everything is harder than you think it is.
Yeah.
Right? So even if the brands are great or you have some really talented people there, taking all of their problems, which they obviously have many, and integrating them with all of your problems and trying to make it all work out smoothly, that's a very risky venture. And for us, we haven't made any acquisitions like that, or I guess it's formally us. But I think there's opportunity and potential for massive ones in the future. I think we're going to see some consolidation at the top. It's just a total speculation on my side. But on the back end, I just think it's going to be very difficult, right? Because obviously there's flawed entities, and every entity has some level of flaws. And you just try to smash them together, it's going to cause problems, in my opinion.
Yeah. What about? Do you want
I totally agree. I also a little bit skeptical about applications of really big aggregators. I think there might be some opportunistic in the future. I think it's not now, to be honest. Also, given what we said before, like in terms of consciousness of capital, like you need to invest a lot of capital. You need to, if you aggregate two large aggregators, you most likely will lose the valuation arbitrage that you might have when you buy a small business versus a big one. So you will already immediately lose, one of the growth levers, for the investors. I think one. Second is obviously the integration. Like I totally agree. I think, could imagine the merger between CelleraX and Thrasio. I think it's going to be a mess, right? It would take, CelleraX is 3 years old, Thrasio is 4. I think it would take 2 to 3 years to integrate the companies together. I think if there's still, enough, a good number, of targets to acquire in the market and good quality, I think there's probably no need. I think what's going to come in the market is probably the distressed aggregators. Those are probably going to come cheap. I think equity is going to be wiped out. I think it's going to be the debt holders just going to probably ask you to take the business over and, just swap paper. But obviously, you're going to lose the quality of the portfolio most likely, right? Because these guys are distressed because they couldn't, raise more money because the quality of the portfolio that they acquired was just quite low.
Could you articulate what distress aggregator is for the audience for a bit clarity?
Yeah, no, I think I don't think there's a definition. I'll try to give mine. I think if we define aggregators like young companies as we are, it's a startup at the end of the day. Obviously, we'll scale up at some point. I think you need to raise money. Obviously, most of us are profitable. I think that's very, very, very different, sector from many other startups. We are profitable. We've been profitable since the beginning. I think most of us are, because the underlying businesses are all profitable. Obviously, you need to invest and so on and so forth. I think there's definitely a path to profitability for any of us. Obviously, we need to be conscious with the margins. We know what's happening in the sector. I would say a distressed aggregator is one that basically deployed this capital really poorly, and so basically really splash money. I think one of the most important basis of the business model is that you acquire revenue, you acquire EBITDA, so you're meant to grow. But obviously, if you acquire not just at a high valuation, but what you acquire is declining, you're just splashing cash and you're not generating anything for your investors. So the next time you'll come and ask for money, maybe your existing investor base will try to give you help, but obviously you won't be able to raise external money. And at that point, if you need money to grow or just to exist, it's just going to be really hard. So it's a long definition. That's how I would explain it. In that case, as I said, the equity investors most likely will have lost their money, I believe. As you know, many of us have, large tranches of debt as well. I think the debt investor will try to save their money and
there's covenants on debt too that says you hit certain thresholds and you no longer, the spigot is turned off. But the simplest way to look at it is you have an aggregator, they purchased 10 brands, they've averaged paying 6x EBITDA on it, their portfolio's declined by 20%, they're paying 17% on their debt per year, the math just stops working. And that's when investors start asking questions, and that's when they turn things off, and that's when things get ugly.
So, main takeaways from this, agree, definitely. For all entrepreneurs here, try to listen to this as, okay, if you are about to prepare your business, make an exit to an aggregator, try to find out these things. Because there is a lot of aggregators having these problems. We have already got brands that we didn't win the bid for early Q1 this year that are back on the market, wants to sell to us or other aggregators due to that aggregator that won the bid, maybe that's why, and they couldn't raise money to actually complete the acquisition. So that's one key takeaway for everyone to have that in mind. It could be hard to understand these things, it's different things, but try to do that. Ask someone, ask Danny, or reach out to me, I can help out and try to find out. Try to do that. Also another thing, try to find someone that already have sold to the aggregator to get a real reference, not the references that are on the web page. Try to find something else. You all know tricks on Amazon, right? You can see who own a brand. Figure it out. Reach out to those entrepreneurs. How was it? Were they fair? Were their account managers good enough? Did they talk about the order inventory? Were they in balance? Were they able to actually grow your brand? Did you get your earnout? Ask all these questions. Try to be hard. If you have built something up for 4, 5, 6 years that is worth a lot of money, don't just give it away. You need to have that, capture that value that you have fought for your whole life, maybe. Maybe it's your first business. So you can be the second wave, as Danny talked about. Take that money home, and then you will have a really good second wave coming.
Excellent. And let's move on to the impact of war on materials. Are you guys starting to feel the pinch now in some of the sectors for the brands that you've got? Starting with Olivia.
Thanks, Danny. Yeah, obviously. The reality is we're feeling all the same pressure points as you guys are. We're no different. There's no magic wand that we're able to wave. I think the one advantage is that we're doing it at scale, right? So Branded has $200 million of revenue, and you have a slightly different negotiating power. When you have that, you're able to organize shipments and crates a bit differently than if you're a smaller brand. But for sure, we feel like we feel the same pain as everyone else, and we're also navigating through that, doing it at scale and doing it with multiple brands. So it's by no means easy, and I think we can all agree that it's not obvious when it's going to end. But every year will come with its own problems and challenges, and I think the nice thing that I feel is that I really back our operating team and the platform we built, and we have very smart people focused on very specific problems, and we're able, obviously we have the capital and the scale to be able to build that out. So problems will come. This is this year's problem. There'll be more problems, different problems next year, end of this year.
There's always a problem.
There's always a problem. So it's kind of about having the team and the capabilities to be able to put minds on that and solve it the best way you can.
I think what we found, overall one practical tip is definitely build relationships with a second or third factory. I mean, they might be coming to you trying to pass on costs. This goes beyond the current situation, but overall inflation, macroeconomic headwinds, and you don't really know how much of it is fair or reasonable. They might point to some data, but you might not have gotten the best offer in the first place, but you were kind of happy with it because your business was humming at 25% margin, but then you might be going to a different manufacturer and they might still offer you 25% discount. So I would definitely, in this environment, and then probably going into next year as well, I think it helps to have multiple relationships back out. And at least it will give you a better feel for what's a fair price, and will give you some bargaining power, negotiation power with your suppliers, because definitely don't say yes to everything, trying to push back as you should. I mean, that's definitely what we're doing. We're finding sellers are not doing sufficiently enough, or there's definitely opportunities left on the table.
Indeed. So Winter, add here. Raw material costs.
Yeah, no. I mean, obviously, same things that everybody's facing. I totally agree with David. I think I've barely seen any in my personal experience, etc. I've barely seen any seller with a backup supplier. I think this is very important. Obviously, as they come back with higher quotes, you might want to change. The other thing I wanted to add is obviously always be mindful with squeezing suppliers too much as well. I think you really need to be very conscious. It depends on the products you're selling. Obviously, if it's a very quality product, I don't think you should squeeze obviously too much on the suppliers, because they might do
their own fit margins as it is. So if you squeeze them, it's going to be nothing less, so your quality goes down.
Absolutely, that's the thing, right? And we're here selling goods at the end of the day. So to be honest, I think I would be really, really conscious on squeezing the suppliers too much.
Just a real quick thing. As costs go up, you can't be afraid to pass on costs to your customer. You guys are in the business to make money, period. Right? Conditions have changed, and even if no one else is moving their price word up, you have to experiment and pass that on. Otherwise, you'll kill yourself. And that's what we've seen in the seller community, and honestly, even some of the brand management, is there wasn't enough chutzpah, as we would say, to actually say, you know what, we're going to raise our prices, and we're going to experiment with this. We're going to let the experiment run and see how things go. And for me, it's just, you have to be cognizant of what your costs are. So a lot of sellers will run and they'll be like, oh, I'm moving units, my ranking's great, and then they go to pull their numbers at the end of the year, right? And they're close to break even. In this new environment, you have to factor in all these changing costs and variables.
Indeed. Okay, so to finish off, I'd like to go around the panel. Crystal ball, starting with you, Olivia. The aggregator space, where do you see it in a year's time? Give us one or two predictions.
So for sure, I think it will consolidate a bit, both for good and for bad. I mean, I take some of the points that people made around larger aggregators consolidating and combining problems, but also this is a model that works at scale. So to support the platform that we need and make a good profit margin below that platform, you need a certain amount of revenue. And so I think combinations can also strategically make sense from that point of view. So I think you'll see a smaller number of aggregators, but the aggregators that do remain will be much healthier, smarter, and better funded.
So, except from what I said, I mean, as an entrepreneur, there is a lot of more information out there nowadays compared to 3 years ago, 2 years ago, or even yesterday. So try to put some time and energy into the process if you are about to exit your business, because there is a lot to learn before you enter in that process.
Look, there might be some blood on the streets right now. This space is not going away. Amazon internally right now, my guess, is building out support teams to help aggregators succeed. They see aggregators in a positive manner. They generally don't cut corners. Their operation is more professional. They're better at branding. They're overall better at customer service than the average seller is, right? So they want to see this space continue. There will be some wobbliness, I think, for the next 6 to maybe 9 months. And then I think we're going to see some steady growth. I don't think we're going to see another explosion happen, but we're going to see a nice, in my guess, particularly if the economy, if we're in a recession right now, which I think we pretty much are, right? The average recovery time for the last 15 recessions, 8 months? So you get back to where that market gain is. So I'm expecting the wave to be roughly over in the economy in general in the next year or so. So that means we'll have better funding, smarter aggregators, and really good opportunities for sellers to enter the market and exit.
Yeah, I totally agree with what everybody's been saying. It's not going anywhere. It's going to go at a different pace, which is a good thing, actually, because we're going to see better deals out of it. Aggregators are going to become increasingly strategic in their acquisitions, and other types of buyers are also getting more and more interested in this space. Traditional strategic buyers, financial buyers who are not necessarily looking into these acquisitions. So I think it's going to be increasingly important for sellers to find the right time and to sell and find the right buyer for them. Like, running your business is not a sprint. We went really fast last year, but now it's really about doing everything you need to do in order to prepare to be ready when the time is right and finding that right fit. So there's a lot of opportunities coming soon in this space.
How many years do you say? 8 years? In 8 years, you said?
No, in the next 12 months.
12 months, okay.
Tell us what happened.
I thought you said 8. I was scared. No, okay. I prepare for 8. No, look, I think, I also agree with everything that's been said. I think the most important thing to remember, it's at the end of the day, it's e-commerce, but it's consumer, right? There are so many consumer companies. There are so many, consumer packaged goods being sold. I think we're all playing, at the end of the day, we're all going to become consumer companies, right? We are acquiring, but we'll become companies selling goods. So there's so many of them. I think we're going to be probably the best position to sell things online, which is great. I think e-commerce, I was speaking with David again earlier in the panel. I am a strong believer of the e-commerce penetration. I think it's just going to continue. I don't know if anybody can argue with that. If they're going to be right, it's going to be very surprising. So I think e-commerce is going to take share, which is the single most important thing for our business. Everything else, Amazon raises prices is not important. As long as e-commerce penetration grows, the e-commerce space grows, the most important is the traffic on Amazon, right, or the platforms. So I'm a strong believer of that. So I think, there's going to be a few months of, bumpy months, but I think I totally see that, each of these companies, if we deploy the capital properly, I think we're going to steadily grow. And in a few months down the line, there's going to be, maybe a few aggregations, a few exits, which is obviously important. We're all venture capital, private equity backed, so there's going to have to be an exit. I was betting on Thrasio, most likely. Most likely it's going to be the first one, but just, in terms of years. And the other very important thing to remember, I think it was mentioned, the oldest company in the market is 4 years old or so. I have never funded a company. I think most in this room have. Hopefully we'll do at some point, but it takes years, right? It doesn't take 1, 2, 3, or 4 years. To really build a large company, it can take decades. It can take a decade to make a really good aggregator at some point. So I think it just takes time.
Yeah, I mean, what everybody else says, I think the next 12 months for sure will be challenging, but I think in this environment, all the sellers, aggregators will continue to upskill, professionalize, and the sellers and both sellers and aggregators that are going to navigate this period successfully, I think will do exceptionally well for the next 5 years, because I think it goes in waves, and we've seen Amazon had an amazing run from really since it started all the way up until 2019, and then obviously 2020. Now it's kind of one of the more challenging periods, but there'll be times when you'll get the wind will kind of hit your sail again, and the ones which are prepared will take advantage of that and do exceptionally well. So I'm really excited for kind of the next year and thereafter.
Excellent. I'm going to state the obvious. Those who are great operators with a war chest in the bank will do well or survive at least, right? And then those who don't, who are not operators and they're good at raising money but no operation skills, I think they're going to suffer quite heavily in the market in the next 12 months. But what do I know? I'm just a podcaster.